Navigating risk. Harnessing the power of option strategies for investors. In the unpredictable realm of financial markets, where volatility can be both a boon and a bane, investors seek strategies to manage risk effectively. Among the arsenal of tools available, option strategies, notably covered calls and protective puts, stand out as powerful instruments that empower investors to navigate the complexities of risk management. Understanding how these option strategies function can provide investors with a valuable toolkit for mitigating risk and enhancing portfolio resilience. Covered calls. Unveiling the safety net. At the heart of covered calls lies the concept of generating income while managing downside risk. This strategy involves holding a long position in an asset, typically a stock, and simultaneously selling, writing, call options against that position. By doing so, investors collect premiums from the call options, providing a stream of income that can offset potential losses. Consider an investor who owns 100 shares of Company A, currently trading at $50 per share. The investor, skeptical of near-term market volatility, decides to implement a covered call strategy. They sell a call option with a strike price of $55, agreeing to sell their shares if the stock price reaches or exceeds this level. In exchange for this commitment, the investor receives a premium, adding to their income. This strategy introduces a buffer against potential losses. If the stock price remains below the $55 strike price, the investor keeps the premium collected from selling the call option. If the stock surpasses $55, the investor still profits from the appreciation up to that level but has effectively capped their upside beyond the strike price. Protective puts. Safeguarding investments. Protective puts, also known as married puts, provide investors with a straightforward mechanism for guarding against downside risk. In this strategy, investors purchase put options alongside their stock holdings, granting them the right to sell the underlying asset at a predetermined price, the strike price, within a specified time frame. While this insurance comes at a cost, the premium paid for the put option, it acts as a safeguard in the event of a market downturn. Imagine an investor who owns 100 shares of Company B, currently trading at $60 per share. Concerned about a potential market correction, the investor decides to purchase a put option with a strike price of $55. This put option allows the investor to sell their shares at $55, irrespective of the current market price. If the stock price remains above $60, the investor incurs the cost of the put option but retains the upside potential. However, if the market experiences a downturn, the protective put provides a safety net, allowing the investor to sell their shares at the predetermined strike price, mitigating losses. Combining strategies. A holistic approach to risk management. Savvy investors often deploy a combination of option strategies to create a holistic risk management approach. By blending covered calls and protective puts, investors can tailor their risk exposure to align with their market outlook and risk tolerance. For instance, an investor holding a diversified portfolio may implement covered calls on certain stocks to enhance income generation, while simultaneously employing protective puts on other holdings to mitigate downside risk. This nuanced approach allows investors to balance income generation with risk mitigation, adapting to the ever-changing dynamics of the market. Risk-reward dynamics. Striking the balance. The use of option strategies introduces a delicate dance between risk and reward. Covered calls may limit the potential upside in exchange for premium income, while protective puts incur a cost that can impact overall returns. Striking the right balance requires a keen understanding of market conditions, individual risk tolerance, and investment objectives. Consider a scenario where an investor expects moderate market volatility but desires additional income. They may choose to implement covered calls on stable, dividend-paying stocks in their portfolio, capturing premiums while potentially sacrificing some upside. Simultaneously, the investor may deploy protective puts on growth-oriented stocks, providing a safety net against unforeseen downturns. Conclusion: empowering investors in a volatile landscape. In the dynamic landscape of financial markets, risk is an inherent component of the investment journey. Option strategies, such as covered calls and protective puts, offer investors a powerful means of managing risk, providing both income generation and downside protection. As with any financial tool, a nuanced understanding of these strategies is essential, empowering investors to navigate the complexities of risk management with confidence and agility. By integrating these option strategies into their toolkit, investors can tailor their approach to market conditions, enhancing their ability to weather the storms and capitalize on the opportunities that the ever-evolving financial landscape presents.